So last week was all about the US jobs report. We had the ADP numbers and the JOLTS numbers during the week. They're private sector, readings of the US jobs market. Historically, they weren't great in terms of leading for the non-farm payrolls or the official numbers. But the last couple of years, they've gotten really quite good. Maybe that means that the US government is sharing their information a little bit better with the private sector. But regardless, the headline number was that the US non-farm payrolls saw the employment change and hourly earnings print better than expected, which means people are earning more money. There's the hourly earnings, and that's, inflationary, but it's also positive. And the employment change showed that there were more people employed than was expected, and that was the prior month. The downer on the employment report was that the unemployment rate rose from 4.1 to 4.2. That rise in unemployment, market people normally call that seasonal stuff, but what that means is that there was a change in the participation rate. So the amount of people who are actually classified as unemployment is in different countries is deemed in different ways. In the States, it's deemed by people who are claiming unemployment benefits. So it's a ratio of the number of people who are claiming unemployment benefits based versus the number of people who are actually earning income. So that's how unemployment is based. Here in Australia, it's a little bit different than that. We strip out a lot of people who are unemployed from our numbers for whatever reason that makes the government look better than what it really is doing. But in the States, that's pretty much how they do it. They take the number of people who are claiming unemployment benefits and the number of people who are actually employed. And while
we did see a firmer US dollar, Jeff, out of that actually.
Well, so I mean,
didn't happen straight away. We took
like Meatloaf said, 2 out of 3 ain't bad, right? So I mean, two parts of the report were good.
Exactly.
The other part of the report wasn't. I think there were some revisions in there as well. So I mean, normally when there are revisions, markets kind of take that with a grain of salt. My view is that the younger people on the bank desks these days don't actually understand what the revisions are, but that's just me. That was last week. On Mark will confirm my cynicism. So that was last week. I think where would the US dollar was broadly firmer over the week? Would you say?
Yeah, I mean, initially sort of weakened, but then it sort of caught up and ended up finishing stronger at the end of the session. I think it took the markets time to sort of digest that information.
Yeah, fair enough.
Especially because unemployment rose at 4.2%.
Yeah, still good though. It's been a lot worse. All right, so that was last week. This week is mainly about interest rate decisions. So we've got the RBA in Australia announcing on Tuesday. The market is still broadly expecting no change on that one. The big four banks are still expecting the first move from the RBA to be a cut in February. They don't meet in January. But I think we might find that some of them, at least one of them or maybe two of them, are going to start to push that out a little bit. Michelle Bullock hasn't exactly been very bullish on rate cuts. So it's not like she's preparing the market for cuts. We'll see what eventuates out of that this week and then into early next year. On Wednesday, we've got the US CPI number. That's expected to come in plus 0.3 on the month. That is, I think, unchanged from the month before. It doesn't sound like much, but if you add up 0.3 every month for 12 months, it certainly adds up to a decent, significant number of inflation. I think what will happen is that if the US inflation is much weaker than that, we might see a little bit of dollar selling. If it comes in as expected, it's probably just going to be treated by the market as a bit of a yawn. And I can't see it coming too much higher than expected.
I think if it ticks higher, like 0.4, 0.5, you could see a strong dollar rally, and that will decrease the likelihood of the Fed actually cutting rates. It's sitting on 85% at the moment. I'd expect it on the 19th of December, but I think that will come down if we do see an uptick in CPI. What do you think, Jeff?
I think with oil prices having come off in the last couple of months, there is very close to zero chance of it being higher than expected.
Fair enough.
Well, that's the biggest input to CPI that's variable, right? So the biggest input is the price of oil. I think in the States in particular, petrol prices is the second biggest household expense after mortgage and rent payments. A lot of people have their own businesses and they drive around, and their cost of actual petrol is actually a huge cost to the inputs to virtually everything everywhere, but especially in the States. So I would say the chances of it being higher than that 0.3 are about 10 to 15% at best. On Wednesday, we've got the Canadian rate decision, and I think, Mark and I are being consensus in that Canada has been very good at flagging what they're doing with interest rates over the last 6 months. This will be, I think, the market's expecting a 50 basis point cut, and I think this will be the third consecutive one. Last month, the market was so happy that they flagged it and that it came in at 50 basis points that the Canadian dollar also actually firmed. So normally when there's a rate cut, that currency weakens just because of interest rate differentials, but it actually firmed the last time. Go on.
I think it depends on what the central bank says afterwards. So if they cut rates by 50 basis points, that's sort of already baked in the price. At the moment, if they sort of come out and say there's further room to cut rates, maybe 2 or 3 times, you'll most likely see the Canadian dollar weaken on the back of that.
Well, they can't keep doing 50. I think they're at just over 2 now, right?
Yeah.
So, I mean, if they keep doing 50, they're going to be negative, and no one really wants to do that.
I mean, the benchmark for all central banks are 2.5, 3% maybe. That's where they sort of stop, about around there.
Generally, right? So, I mean, the Swiss central bank is much lower than that. Swiss rates are generally somewhere between 1% and 2%, and have been since World War II. I guess, Western world, so we're talking about Canada, Australia, New Zealand, and the US and the UK. Yeah, we're kind of around that, more like 3%. Remember, the last time that it came down really quite low was in the middle of COVID, and honestly, it won't happen again.
Yeah.
So, God, let's hope COVID doesn't happen again. Moving on to Thursday, that's the Australian employment report. The market is expecting that to firm slightly to 26,000. What that actually means is 26,000 new people or new jobs created. Doesn't sound like much, but remember, we're running a population of 30 million people. I think so. That will be the November number. I'm a pretty big believer that Decembers are always really quite good for employment in the Western world because of those seasonal employments. People that work in retail that get those December, January jobs normally support the market. Out here, we do split out full-time from part-time, but they both combine together for the actual employment report. So if you're a part-time person, I think if you're working more than 5 hours a week, you're classified as employed. Thank you very much for that. All right, cool. So I think that's the focus for this week. Just before we move on, we had a Reuters report over the weekend that said that the Chinese central bank had started buying gold again. In 2023, China was the biggest buyer of gold on the planet. And this year they've been actually really quite quiet. The talk was that they were waiting for it to fall back to that 2,400 area. It looks like they're not going to do that because last month they actually added some holdings of their gold. So if they're going to come back, they're probably going to come back as a big buyer. The rumor out of China, and obviously their officials never really confirm anything, but the rumor out of China is that they're trying to diversify out of their US dollar holdings into gold and into euro. So that could pressure the dollar and could certainly support gold.